Everyone wants to know, should I invest for the long term or try to make money fast in the short term? Both strategies have their fans. Both can make money, but both also come with risks. Today, we'll break down the pros and cons of each. Look at real examples, and by the end, you'll know which strategy fits you best. Short-term investing usually means buying assets you plan to hold for days, weeks, or maybe a few months. Think day trading, swing trading, or chasing the next hot stock or crypto. Example: imagine that you buy Tesla stock at TUFT and sell it 2 weeks later at 2. You made $30 per share. If you had 50 shares, that's $1,500 profit in just 2 weeks. The appeal? Quick money, excitement, and fast returns. The risk? Volatility. The same Tesla stock could just as easily drop to 2, and instead of making 1,100, you're losing 1,500 in the same time frame. Long-term investing means holding assets for years, sometimes decades. It's about growth, not quick profits. Think buying stocks, index funds, real estate, or even Bitcoin, and holding on for the long haul. Example: if you invested $1,000 into Amazon stock in 2010, when it was about 120 a share, split adjusted, today it would be worth over $20,000. That's the power of long-term investing. Long-term investors focus on compound growth. Even 8 to 10% per year adds up massively. If you invest $500 a month into an S&P 500 index fund, averaging 10 yearly returns, in 20 years, you'd have over $30,000 on, even though you only put in a $20,000 yourself. Fast profits possible. More exciting, hands-on, can take advantage of trends or news. Extremely risky, emotional roller coaster, requires instant monitoring, higher taxes on short-term gains. Lower stress, you don't need to check daily. Takes advantage of compounding. Lower tax rates on long-term capital gains. Historically, markets trend upward. Requires patience. Returns feel slow compared to quick trades. Money is tied up for years. Most data shows that the majority of day traders lose money. According to studies, up to 90% of day traders fail long-term because it's so hard to beat the market consistently. Meanwhile, if you simply bought the S&P 500 and held it for the last 30 years, you'd have averaged around 10 annual returns. For example, $10,000 invested in the S&P 500 in '93 is worth over $160,000 today. Long-term investing doesn't sound exciting, but it works. So, which is better? The truth is, it depends on your personality and goals. If you love the thrill, have time to research daily, and can afford to take risks, short-term might work for you. But if you want steady, reliable wealth building without losing sleep, long-term is almost always the smarter path. Many smart investors actually mix both, keeping 90% of their portfolio long-term and maybe playing with 10 for short-term trades. At the end of the day, the biggest mistake isn't choosing short-term or long-term. The biggest mistake is not investing at all. So ask yourself, do you want excitement or do you want stability? Because your answer will determine the right strategy for you. Thanks for watching. Don't forget to subscribe for more investing breakdowns and drop a comment. Are you a long-term investor or do you like short-term trading?